We had a question come in from Manuel, and he's a US growth stock client. So thank you for sending this in, Manuel. And he says, could you provide a synopsis on Qorvo's growth prospects and valuation for investment? So Qorvo Inc., QRVO on the NASDAQ, currently trades at a price of around $95 and has about a $9.7 billion market cap. So the company develops and commercializes technologies and products for wireless, wired, and power markets worldwide. The company operates through three segments now. They actually just increased it to three segments recently. So these are their high performance analog segment, their connectivity and sensor segment, as well as their advanced cellular segment. So essentially, the company offers mobile devices such as smartphones, wearables, laptops, tablets, and other devices, as well as it provides SiC or silicon carbide products such as Schottky diodes and transistors for automotive, industrial, IT infrastructure, and renewable energy markets. The internet's probably going to rip me apart on how I pronounce that. Anyways, so the stock is down about 52% from its 2021 highs of approximately $200 per share. And on November 2nd, the company announced a $2 billion share repurchase program, which is good to see while the stock has been hit pretty hard in the market. So looking at the fiscal Q2 2023 results, which were actually just reported on November 2nd, revenue was down about 7.7% to $1.16 billion. Looking at their segments, the high performance analog segment revenue was actually up 47% year over year, driven by defense and non-consumer related power products, including silicon carbide. Their connectivity and sensor segment was down about 19% year over year due to weaker consumer spend, primarily for Wi-Fi enabled products. And their advanced cellular segment was down about 15% year over year, reflecting lower smartphone unit volumes within the Android ecosystem. Gross margins were also down about 3% to 46.5%. And looking at profitability, they posted GAAP diluted EPS of about $1.82 per share, which is down 36% from the same quarter last year. And adjusted EPS was down about 22% to $2.66 per share. And I did look at the adjustments that were made, getting GAAP to non-GAAP EPS. And the biggest adjustment to non-GAAP EPS was stock-based compensation, which equates to about 30 cents per share, which we added back to GAAP EPS, or which they added back to GAAP EPS. And just quickly looking at the balance sheet, they have net debt of approximately $1.14 billion and a trailing net debt to EBITDA multiple of under 1 time. So that doesn't look too bad. Now, the company did provide guidance for their Q3 2023, and it doesn't look very good. So they anticipate revenue to be between 700 to 750 million. So at the midpoint, this would indicate a sequential decline of 37% and would be the lowest revenue seen since the quarter ended March of 2020. So, several quarters in between, they're hitting a new low, which we don't like to see. And for non-GAAP diluted EPS, they provided a range of 50 cents to 75 cents per share. And at the midpoint, this would mean adjusted EPS would be down 79% year over year from Q3 of 2021. And utilizing this adjusted EPS guidance, the company trades with a forward price to adjusted EPS multiple of about 11 times, which, you could say looks reasonable, but looking at its growth prospects, maybe pricing it around fair value or even overvalued. Now, I just wanted to pull out a couple comments made by management on their conference call, looking at the guidance. So they say, our current view of the second half of the fiscal year reflects ongoing weakness across end markets, primarily in consumer-related areas, as well as a more acute inventory correction at our Android smartphone customers than was previously predicted. At the volume levels assumed in our guidance, we expect our inventory position to remain elevated, but improve by the end of the fiscal year as we undership normalized demand and reduced factory utilization. Simultaneously, we are cutting costs in our factories to offset the impact from lower volumes. Unabsorbed fixed costs will impact gross margin in the second half. And they went on to say, The most dominant headwind is the factory underutilization, which is generating over 700 basis points of gross margin headwind, which is not good. So, to conclude, it appears that headwinds are anticipated to persist through the second half of the company's fiscal 2023. Therefore, I would remain patient with the business as we will likely see the next 2 quarters post lower revenue and profitability than what we have seen with quarters over the last 2 years. Overall, I will say that the company has a good track record of growing revenue and profitability, and right now it trades with, you could say, reasonable valuation multiples. But given the weakness anticipated in its operations, these multiples may continue to increase, and they probably will, as profitability declines from elevated levels. So again, I think this is just one that we would monitor until it shows some signs of recovering towards growth and profitability.
Yeah, I mean, we don't, you know, the negative growth going forward in terms of the next quarter, just it's something that we would stay away from at this point. It just doesn't meet our criteria. We want to see growth moving forward at a reasonable price. There's no growth in this business, at least in the next quarter, and there's no outlook that shows us right now a growth path near term on the business. So it would be something that we would avoid, even if we thought it was expressively cheap, which really on an earnings basis, once you take out some of those, share compensation numbers, it's actually not even that cheap,
No.
particularly, when you have no growth,
And
when you
like
have
you said
negative
many
growth,
times
right?
before, is when you see a company posting, substantially lower revenue and profitability in following quarters, it's hard for a stock to
Mhm.
actually, gain some momentum and go for a run. It's hard to see a stock
Yeah.
actually increase in that kind of environment. Well, the fundamentals of the business aren't so bright and
Unless something
getting worse.
completely unexpected happens, which you're
Yeah.
just crossing your fingers, we're not going to do that. We don't
Yeah.
see a growth path right now. We wouldn't invest in it.